Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Tuesday, everybody. Today is May 27th, 2025. I hope you all had a wonderful extended Memorial Day weekend for those of you who are stateside here in the U.S. And for everybody else, well, it's Tuesday. We had quite a development overnight in Japan. Top story this morning is this big rally in Japanese bonds. Now, I was talking with Mish and we were saying, like, look, this is the biggest story in the world right now. It's probably not going to get people very excited, like, oh, yay, the Japanese bond market. Oh, very big things happening. Yo, this is important. Seriously, this one matters, all right? We talked last week about this brutal sell-off that was happening in these long-term Japanese government bonds. And yes, you should care about that because that will eventually reach across the pond and affect you here. So people were worried that, the Japanese, the BOJ, and they have this ridiculous modern monetary theory principle over there, runaway government deficit spending. Stop me if you've heard this one before. And people were starting to sell Japanese government bonds because of that. And the Japanese central bank was buying less of them, which meant there pretty much is no market for this garbage. Well, over the weekend, it got really bad. And all of a sudden, late last night, Monday now, the Japanese finance ministry sends out a survey. And the market rallies like crazy. And you're like, what? A survey? Why does a survey make the bond market rally? That's a silly gesture entirely. And you're right, it is silly. The survey was basically the Japanese finance ministry saying to bond market participants, which is banks, insurance companies, hedge funds, they're like, hey, guys, let's just say hypothetical. We were going to do what Aunt Janet's doing over in the United States or what she used to do. Let's say, hypothetically, we were going to issue more short-term bonds instead of more long-term bonds. And, if we issue fewer long-term bonds, that means the supply is reduced, the demand stays the same. That should send the price higher and the interest rate lower. Is that something you might be interested in? And the market grabbed that information as a sign that the finance ministry was going to shift to more short-term issuance, and boom, big rally in Japanese long-term government bonds. And that's sending borrowing costs. Really, this is rippling across the world right now. Interest rates in the UK took a dive off of that. Interest rates in the States even went lower off of that. It's amazing how something like a silly government survey is enough to cause major moves in the market like this. So, look, it worked. And this is exactly what Janet Yellen did. It's a short-term thing. It doesn't solve the problem of modern monetary theory in Japan. It doesn't solve the problem of runaway government deficits. Now, why did they do this? They did this because on Friday, a lot of people didn't catch this because it was the start of a long weekend. Japan was actually pretty close to some kind of a major financial crisis. I don't know how close. Maybe the quants with all the Greek letters could figure that out of exactly how close we were. But one of Japan's largest life insurers reported that they were seeing, as Nippon Life, they reported a $25 billion surge in unrealized losses from their bond portfolio, 3 times what it was a year ago. Unrealized losses just means we haven't realized the loss yet. We haven't sold anything, but what we have has gone down in value so much, when we sell it, we will realize that loss. Now, look, that is the exact failure mode that took down Silicon Valley Bank in the United States in March of 2023. It was unrealized losses on their bond portfolio. That failed Silicon Valley Bank, Signature Bank, First Republic Bank. Right? It was the second, third, and fourth largest bank failures in U.S. history happened in rapid succession because of unrealized losses on bonds. It's a problem which still lingers on the balance sheets of most banks in the U.S., by the way. But that problem was getting so big in Japan, so fast as we were watching that sell-off in Japanese government bonds last week, that warning from the insurer led to that survey from the Ministry of Finance, which is what's causing this relief rally. Now, look, what Japanese life insurers and banks like Norinchukin are doing is they're slowly moving from sovereign bonds into higher yielding assets to try to make up some of those losses, things like CLOs, collateralized loan obligations. Well, those are made up of predominantly commercial real estate debt. Yikes. So they're out of the frying pan into the fire because we have something of a crisis in commercial real estate. You may have noticed those assets are not worth anywhere near what they're being held on the books for. So the Japanese banks and insurers have a pretty big problem here. And this survey was all about trying to calm the public without actually making any sudden changes in policy. They're like, let's just ask them a couple of questions that might hint what we're thinking about doing and see if that calms everybody down. It worked. Again, it's you wouldn't think something like this would really matter that much, but it does. And this comes on the heels of this big warning from the Bank of International Settlements that came out warning about the relentless rise in government debts around the world, saying that the days of ultra low interest rates are over and that governments around the world better get their house in order quickly before public trust starts to fray. That's their words, not mine. Yes, we wouldn't want to have any fraying of public trust in the 2020s, right? Luckily, our faith in our government institutions and financial overlords is unfrayed up until this point, right? Any fraying? Any of you guys in the back, maybe? Little fraying going on there? Anyways, look, the Bank of International Settlements is warning it, guys. Interest rates, we are at the beginning of a multi-decade period of higher interest rates, means more borrowing costs. And if governments don't figure out a way to stop their deficit spending quick, they are going to have big problems. By the way, China, ultra easy monetary policy. They're going in the other direction with the stimmies. Japan, they're going in the other direction with the stimmies. The European Union just signed their big bill getting rid of the debt breaks because they're going to increase their spending to build up their militaries. The United States, forget it. We just had that circus of a Doge situation going on, and then the federal judges came in and basically said, no, it's illegal to cut spending in the United States. Yeah, governments around the world any day now are going to get their fiscal houses in order. Just don't hold your breath on that one, guys. Meanwhile, the on-again, off-again tariffs are off again this morning. The U.S. and the EU, we may remember last week we were talking about how, okay, tariffs are back on the menu on Friday, 50% tariffs on Europe because President Trump didn't like the deal they offered and said they were negotiating in bad faith. Well, apparently President Trump and EU President Ursula von der Leyen had a perfectly good phone call over the weekend. Ursula said, no, we really want a deal, but we need another month in order to make that deal happen. So President Trump said, okay, you can have a month. July 9th is now the 50% tariff day for the EU. U.S. stocks are rallying on that news. Bipolar tariff disorder is now officially a thing. We got some other news going on this morning. Tesla sales in Europe are down 49% year over year. That is brand damage by Elon trying to cut spending. Europeans didn't like that one bit. We've got Teeu owner PDD Holdings, big drop in their profit. Their stock is getting clobbered this morning on that news. It seems those tariffs took a big chunk out of Temu's second quarter earnings. No, that'd be their first quarter earnings that they just reported. India's iPhone shipments are up 76% year to year. Big surge in iPhones coming from India. Now, we're going to look into that article and find out that's not really a valid statistic. Yeah, maybe the point of origin is India now, but they've kind of done everything they can to shift as much as they can out of China. Any further progress is going to take a lot longer than that. We had Trump passed an executive order to overhaul the NRC over the weekend. That's big news potentially for energy markets and nuclear stocks in the U.S. We've got this story about China's zero-mileage cars. That's interesting going on this morning. And Volvo laid off 3,000 white-collar employees. More trouble in the auto sector on both sides of the ocean this morning. We got a lot to talk about. Why don't we shrink my big melon of a head and let's see what's happening in the world this morning. Don't forget that like button. And if you're new here, hit that subscribe button right next to it because we do this every morning. So come on back and have your coffee with the melon heads. And right now we've got the S&P is up by about 80 points here, 1.39%. A lot of enthusiasm for that potential progress between the U.S. and the EU, as well as the lower borrowing costs around the world contributing to a rally in stocks this morning. The Dow is up 1.22%, 500 points in the green ahead of the opening bell. It's a good morning for stocks. And the NASDAQ is also up big here, up 1.57%, 329 points to the upside for the NASDAQ. Meanwhile, the dollar is higher by about 0.25% here, 24 basis points to the upside, 99.23 for the DXY. And looking at the bond market here in the States, we've got the longer end is a little bit lower, probably resulting from that Japanese situation. The 30-year Treasury, 4.980. That is lower by almost 6 basis points. The 10 years at 4.471. That's 4 points lower. The 2 years at 3.981. That's off by about a half a point. And the 1 month is down a fraction of a point as well, 4.292%. Looking over at the commodities board, we have got a lot of red this morning. Metal's not doing so good here. Spot gold, $3,299, back below $3,300. That's off by about $42 this morning, 1.25% in the red. Spot silver is also down here, $33.70. That's off by about 39 cents or 1.2% lower, but I still like the shiny. We've got coppers down by 1%. Platinum is off by 0.38%. Palladium is down 2%. And even crude oil is lower again here by 1.1%, $60.84. That's lower by about 70 cents this morning. Looking over at Bitcoin, we are back above $110,000 here. $110,509 to be exact. That's priced on Coinbase. That's up by about $1,000 from yesterday. Bitcoin is continuing this grind higher here. Not quite new highs. We did hit 112,000 exactly. That was on Thursday last week. And we took a little bit of a dip on Friday. We had a pretty severe sell-off in Bitcoin. We have been clawing back up for that one. So Bitcoin's still looking pretty good here. Now, let's talk about what's going on in Japan here. First of all, let's look at the USD JPY chart. We've got the chart is a little bit higher this morning. That means the yen is a little bit weaker here, 143.98. We did get as low as 142.1. Remember, guys, this chart moving higher, that is the yen weakening. This chart moving lower is the yen strengthening. So right now, this little bit of move in Japanese bonds caused by this survey is causing just a little bit of weakening in the yen. Watch these levels down here, though. The yen carry trade remains a risk out there. Now, this is the big move here, the Japanese 40-year Treasury. Big move down in yields. Remember, guys, yields moving lower. That's prices moving sharply higher. There's a lot of buying going on these super long JGBs, or Japanese government bonds. 22 basis points lower on the yield here at 3.31%. This was at 3.7 just a couple of days ago. All right, so you're talking 45 basis points in 3 days. So what's going on here? Let's talk about this one in Bloomberg. Japanese bonds surge on bets that the government may tweak issuance. And guys, I just want to emphasize here, this is may tweak. They haven't tweaked yet. We are untweaked in the Japanese government bond market. They sent out a survey that suggests they are considering doing a thing. They have not done anything yet. That is a very big move in those bonds based on a survey. Japanese government bonds rallied Tuesday on signs that the finance ministry may be prepared to adjust debt issuance following a rout in the market. The finance ministry, in a move that was unusual because of its timing and the wide group of people contacted, sent a questionnaire to market participants on Monday evening that asked for their views on issuance and the current market situation, said people familiar with the situation. As the bond yield curve steepens globally, policymakers cannot afford to sit idle, said Hiroshima Matsumoto, a senior client portfolio manager at Pictet Asset Management in Japan. They needed to send a message that they care about the long end of the market and that they're paying attention. And so I guess this questionnaire, this survey, that was enough to say, yeah, guys, we see, look, this big move in 40-year bonds. We saw it. Here's a questionnaire asking you your opinion on it. And everybody's like, buy Japanese government bonds. This means they're going to intervene and they're going to issue more T-bills, I guess. Not T-bills. I don't know. JGB bills. I don't know what's the T-bill equivalent in Japan? Somebody let me know in the comments. But look, why was this so urgent? I think this is why this was so urgent. And this is kind of the mechanism of how higher interest rates and moves in Japanese bonds, like who cares? This is how it becomes a financial crisis, which will eventually affect your portfolio or affect your bottom line when you go shopping, possibly your job. Japan's top life insurer says unrealized bond losses tripled. And guys, this is exactly what took down Silicon Valley Bank, and it was starting to show up in Japanese life insurers Remember, insurance companies, the business models are indistinguishable from banks. They're just regulated differently. So this was a very big deal here. Japan's biggest life insurer said unrealized losses on its domestic bond holdings more than tripled last fiscal year as rising interest rates undercut the value of its portfolio. Nippon Life Insurance, which last month outlined plans to reduce its holdings of sovereign debt, said on Friday that paper losses on Japanese bonds swelled to 3.6 trillion yen, or about $25 billion as of March. The debt portfolio is made up of mostly Japanese government bonds, largely with maturities of 30 years, which have come under intense selling pressure recently, pushing yields to record highs. Still, the expansion in paper losses won't immediately lead to a crisis, Nippon Life executive Akira Suzuki said at an earnings briefing. The firm is replacing low-yielding bonds with higher-yielding ones. Put a pin in that. We'll be back to it. He said, adding that the market may stay unstable until risk sentiment stabilizes. Just because unrealized losses are growing, that doesn't mean something terrible will happen all of a sudden. And yeah, guys, an executive at a life insurance company actually said that. He actually said, oh yeah, we've lost a ton of money on these investments, but that doesn't mean anything bad's going to happen. It just means, oh yeah, we lost $25 billion. Don't worry. Other than that, everything's going great. The insurer isn't alone in struggling with the impact of rising interest rates. Norinchukin Bank said on Thursday it would be very cautious about buying Japanese government bonds, while Sony Life Insurance said it would take measures, including the sale of government bonds it holds, to avoid write-downs in the event that domestic rates keep rising. So look, this was Silicon Valley Bank all over again. You can see here, all right, we lost $25 billion, but don't worry, we're strong and resilient. And then Norinchukin says, oh, we're not going to buy any of these Japanese government bonds. We're going to be very careful. And this other Sony Life Insurance company says, we're going to start selling our government bonds before things get even worse. Well, selling bonds drives the prices lower and the interest rates even higher, does actually make the problem worse. So you were starting to see these cascading sell-offs in long-term Japanese government bonds that would add to these piles of unrealized losses. This was a banking crisis in the making over in Japan. And I would add this line here that we put a pin in when I said they're replacing low-yielding bond holdings with higher-yielding ones. That's what same thing that Norinchukin was doing. They're selling their JGBs and they're buying basically junk debt, CLOs, commercial real estate debt. They're buying some of the hottest garbage in the market. It's not going to make their problems better. That's going to make their problems worse. And Japan has been doing this for almost a year now. This has been happening with Norinchukin Bank. Now you've got other insurers are getting in on this. So Japan needed to jar something loose here. That survey that went out in the middle of the night that caused this big buying spree in bonds, that was an act of desperation by their Ministry of Finance. And look, this comes amid this warning. BIS urges governments to curb relentless rise in debt. Look at the globalists all of a sudden caring about government spending. Isn't that adorable? Governments across the globe must curb their relentless rise in public debt as higher interest rates make fiscal paths for some countries unsustainable, said Augustin the Hutt, general manager of the Bank of International Settlements, on Tuesday. Large deficits and high debt appeared sustainable when interest rates were kept low after the global financial crisis, allowing fiscal authorities to avoid making hard choices, such as cutting spending or raising taxes. Markets are already waking up to the fact that some paths are not sustainable, he said, warning that financial markets could suddenly destabilize in the face of large imbalances. That is why fiscal consolidation in many economies needs to start now. Muddling through is not enough. The warnings came in the wake of recent steady rises in bond yields in the United States, Japan, and Europe, driven in part by market expectations that their governments will ramp up spending funded by increased debt. Augustin Carstens is warning about the global bond market here. He's saying, confidence in public institutions may begin to fray if you guys don't get your house in order, and interest rates are not going to stay low forever. They're heading higher here. You better fix this mess. Meanwhile, onto the trade war, we've got some progress, or at least the appearance of some progress here. EU plans to fast-track trade talks with the U.S. amid tariff fight. This one came out yesterday. The European Union said it agreed to accelerate negotiations with the U.S. to avoid a transatlantic trade war, signaling a more amicable approach just days after President Trump criticized the bloc for taking advantage of the U.S. and slow-walking talks. There is now a new impetus for negotiations, said Paula Pino, a spokeswoman for the European Commission, who told reporters on Monday, a day after the Commission President Ursula von der Leyen spoke with President Trump by phone. They agreed both to fast-track the trade negotiations and to stay in close contact. Following the call, Trump extended the deadline to hit the EU with 50% tariffs by more than a month to July 9th to allow for more time for negotiations. We had a very nice phone call, and I agreed to move it, Trump told reporters on Sunday. So, looks like on again, off again tariffs are off again, at least for another month while the EU and the US talk. Meanwhile, we've got Tesla's European sales plunge 49% on brand damage and rising competition. Now, recall we just had that previous article, the Bank of International Settlements, saying governments better stop spending so much money around the world. Well, Elon Musk was arguably the only person in the world who actually lifted a finger to cut government spending anywhere in the last, ever. And look at what happened to his company. Brand damage, 49% plunges in sales. European sales of Tesla vehicles plunged in April as the U.S. electric car maker continues to face reputational damage regionally and amid rising competition. Tesla sold 7,261 cars in Europe in April, down 49% year on year, according to the European Automobile Manufacturers Association. That drop came even as overall battery electric car sales rose 34.1% annually. Tesla has faced brand damage over the past few months because of CEO Elon Musk's political involvement with U.S. President Donald Trump, with protests erupting at Tesla dealerships across Europe in March. And don't worry, those acts of vandalism and arson were largely peaceful, I'm told. Tesla, meanwhile, is a little bit higher this morning on this news, 2.55%, $347.93 for Tesla shares, probably being driven by that overall market enthusiasm and the progress between the EU and the US, or at least the appearance of progress. But one company that is not doing so well this morning is Teeu. Trump tariffs claim early scalp. Teeu owner PDD stock plunges on an earnings miss. And this wasn't just an earnings miss. This was an earnings bludgeoning. President Donald Trump's hard line on tariffs is starting to make a big dent in the profits of Chinese companies. PDD parent company of Teeu, on Tuesday reported earnings that missed expectations. Its American depository receipts plunged. PDD is also taking a hit from closing of the so-called de minimis loophole, which allowed products valued below $800 to be shipped to American consumers from Chinese factories without duties or customs procedures. The de minimis tariff rate was initially set to 120% before being cut to 54% early this month. The company's earnings were also hit by weak consumer sentiment at home. Executives said that changes to its platform hit profits in the quarter, though they will help in the longer term. They didn't directly use the word tariffs, but Vice President Jun Liu said challenges have been further accelerated by changes in the external environment. PDD said profit was 14.7 billion yuan, or $2 billion. That is down 47% from a year earlier and below the FactSet consensus of $3.6 billion. Wow, a 47% decline in profit. Do you think maybe the whole Chinese bluster and the whole thing about how, China's fine, we're just going to sell more of this dollar store crap to our own markets and we don't need American shelves? 47% decline in earnings in one quarter. Yikes. By the way, I just want to take this opportunity to say welcome to all you adorable bots from the Chinese 50-cent army. I just love when you guys show up in the comments. Thank you so much for the engagement. Please deposit 50 cents down below, you adorable little globalist government operatives, you. PDD Holdings, look at this stock getting crushed this morning. Let's refresh this. 17.15% lower, trading at $98.80. These are American depository receipts, by the way. Basically, U.S. shares of Chinese companies down $20 here. Now, this is a pretty interesting one here. China summons top car makers over zero mileage used vehicles. Now, we've heard a lot about Chinese automakers making progress in global markets and how, they've been doing so well and selling all these cars, and in particular, BYD making progress in the EV market. But it seems there's been a pretty popular scam going on in the Chinese auto market, and it's been covering up the fact that much like everywhere else in the world, Chinese people can't afford cars. Check this one out in Bloomberg this morning. China's Ministry of Commerce is meeting with some of the country's biggest automakers to discuss whether the industry is using a loophole to mask weakening sales. The meeting, which was set to take place Tuesday afternoon, also included industry bodies such as the China Automobile Dealers Association and online car distribution channels, according to a memo shared by Li Yanwei, an official at the Dealers Association on Weibo. Zero-mileage cars came to public attention last week when Great Wall Motor Company chairman Wei Zhanjun warned of an unhealthy outlook for China's car industry following years-long price wars. The practice sees automakers that have failed to meet their sales targets distribute new vehicles to supply chain finance companies or used car dealers, according to the Dealers Association's Li. These essentially new cars then appear on the resale market with no mileage, and manufacturers record them as a sale despite not reaching the end consumer, he wrote on Weibo. While that would be viewed as fraud in places like the U.S., it's not clearly regulated in China, he said. He urged the Ministry of Commerce and China's Securities Regulatory Commission to stamp out the practice. It's unclear which companies are involved, but Great Wall's Wei estimated that as many as 4,000 secondhand sellers post zero-mileage cars on their platforms. He pointed to the practice as indicative of the chaos engulfing China's auto sector and warned the industry is facing its own China Evergrande Group, the defaulted builder that's an emblem of the country's years-long property crisis. He declined to identify the company he alluded to. Now, that's some pretty alarmist language here. 4,000 dealers are selling these zero-mileage used cars, which is just the Chinese automakers are just selling their brand new vehicles to used car lots, booking it as a sale as if a consumer bought it. But really what you have is just a piling up of brand new cars on the inventories of used car lots. And then this industry insider is saying somebody big in the Chinese auto sector, he doesn't say who, is going to be the Evergrande Group of the auto sector. So apparently there's a crisis brewing in Chinese automakers. That one kind of came out of nowhere. Shout out to my moderator, Mish, who caught that one this morning. That is a cool story. And rounding it out today, we've got Volvo cars to slash 3,000 jobs in white-collar cutback. That's pretty much the whole story there, guys. Volvo is cutting cars, and you've got some tone-deaf executives are talking about how, don't worry, people are going to have the opportunity to take on additional responsibility, which means if you're lucky enough to not have your job eliminated, you're going to get extra work for no additional pay. Congratulations to you. 3,000 white-collar jobs getting cut from Volvo. More trouble in the auto industry this morning. Also, we've got India's iPhone exports to the U.S. soared an estimated 76%. But Trump and Beijing won't make further growth easy. Look, Apple did everything they could to make more iPhones in India. I just want to scroll past a lot of this stuff here. Daniel Newman, the CEO and principal analyst at research firm Futurum Group, noted that shipment numbers reflect final assembly, but are not representative of the entire supply chain and manufacturing process. It was actually a very low lift for them to migrate more and more of the final assembly from China to India, he said, adding that a vast majority of the sub-assemblies are still made in China. So, yeah, this 76% surge in shipments of iPhones, all they're doing is doing the final assembly in India. All of the parts are still made in China and Taiwan. They're just screwing them together in India, and therefore they're getting around a lot of the tariffs that way. Just goes to show you they've already done the easy things here. In order to actually build more iPhones in India, they probably have to start manufacturing those sub-assemblies and subcomponents there as well. That's going to take more time and more capital to get that up and running. And the last one of the day, guys, Trump signs an executive order to overhaul the Nuclear Regulatory Commission and speed reactor deployment. I've been following this one for a while here, guys, and we've been talking a lot about how the AI bubble has a power problem and how they're all talking about nuclear energy. And I've been saying the Nuclear Regulatory Commission is a massive obstacle, and without changes at the Nuclear Regulatory Commission, these reactors just will not get built in time. Well, President Trump is doing everything he can to get around that, including this executive order. President Trump signed a series of executive orders Friday to overhaul the Nuclear Regulatory Commission and speed the deployment of new nuclear power reactors in the U.S. The NRC is a 50-year-old independent agency that regulates the nation's fleet of nuclear reactors. Trump's orders for a total and complete reform of the agency, the senior White House official told reporters in a briefing, under the new rules, the commission will be required to decide on new nuclear reactor licenses within 18 months. Trump said on Friday the order to focus on small advanced reactors that are viewed by many in the industry as the future, but the president said he also supports the building of large plants. When asked whether the NRC changes will result in staff reductions, the White House official said there will be turnover and changes in roles, but total reduction in staff is undetermined at this point. The executive orders do call for a substantial reorganization of the agency. The orders, however, will not remove or replace any of the 5 commissioners who lead the body, according to the White House. That's important because those people are appointed by the president, confirmed by the Senate. They're independent regulators. It's a gray area if he can or can't fire them. That Supreme Court last week, that ruling suggested maybe the president can fire them because the Supreme Court said, not the Fed, but everybody else you can pretty much fire. So he's reorganizing the NRC. Now, there's another very important detail here. Trump's orders also created the regulatory framework for the Department of Energy and Defense to build nuclear reactors on federal land. This allows for safe and reliable nuclear energy to power and operate critical defense facilities and AI data centers, the official told reporters. The NRC will not have a direct role, as the departments will use separate authorities under their control to authorize reactor construction for national security purposes, the officials said. Now, what they're talking about here is we're going to build these smaller or these new nuclear reactors on federal property. These are going to be government reactors, not commercial reactors. Now, right now, the U.S. Navy, for example, operates land-based nuclear reactors as well as shipboard nuclear reactors. Those are not regulated by the NRC. Those are regulated by Naval Reactors, the Navy's in-house regulator. The DOE also plays a role. Maybe you guys could ask Mish for a little bit more clarity on how that works. Not really in my wheelhouse. That being said, what President Trump is talking about here is he's saying the Department of Energy, we want to build nuclear reactors on federal property that are going to be regulated the way we regulate our military reactors. And those are going to be used for national security purposes and AI data centers. Now, that's kind of questionable. Are these going to be government AI data centers? In which case, what are these government chatbots going to be doing exactly? That's a good question. Are these going to be AI data centers that are used to power Sam Altman's multi-billion-dollar charity, air quotes? In which case, how does that have anything to do with national security and therefore not subject to the Nuclear Regulatory Commission? So I've got questions about this. I don't want to see nuclear reactors turned over to those a-holes in Silicon Valley because the mentality that prevails in Silicon Valley is not compatible with nuclear energy. Nuclear energy requires an absolute commitment to safety over production. That is not how Silicon Valley operates. That being said, what the Nuclear Regulatory Commission has done, they have taken it way too far and they have smothered the industry for the last few decades. This change was long overdue. So I hope we're able to get these reactors built. I just hope they don't loosen the standards too much. There's too much riding on that. One accident at one plant will hold the entire industry back for decades. And I just want to say thank you very much to, hey, Ian Ross, welcome to the Melonheads, brother. Thank you so much for becoming a magnanimous Melonhead. I appreciate the support of the channel, sir. Guys, just a reminder, all members get a free super chat every month, and magnanimous Melonheads get access to the weekly Q&A that we do over Zoom. Thank you very much, Ian, for supporting the channel, as well as you, John. Welcome to the Melonheads, John. Thank you very much, sir. I tip my glass in your direction. And the dad, Dan, is here. He says, nearly surrounded by fields of winter wheat. Winter wheat in the summer? Guys, I don't do very much ag here, but shouldn't the winter wheat already be harvested by now? Don't quote me on that one, guys. I don't know the schedule too much, but I tell you, I was speaking of winter wheat. I saw an article this morning. It didn't make the cut, but there's a lot of farmers are filing for bankruptcy in Brazil right now, probably because of those lower commodity prices, and it's causing stress in a lot of Brazilian banks. It was Banco do Brasil was saying they're seeing their defaults rise substantially because of farmers, and that's the bank that finances most of the loans to farmers there. So those lower agricultural commodities are hitting Brazilian banks. And then we got the Dad Dan surrounded by winter wheat that I believe should have been harvested already. Okay, they're saying planted in winter, not necessarily harvested yet. Okay. But keep an eye on that story, guys, those lower commodity prices. And that could also be contributing to problems at Norinchukin, that Japanese bank that is having the problems with the unrealized losses in bonds, and they're buying the CLOs. Well, Norinchukin also makes a lot of loans to Japanese farmers. So if those lower commodity prices are hurting the farmers, could be spillover into the financial world. Thank you, Dad Dan, for that anecdata, sir. Pigo's Trading Desk says, just want to say good morning, my brother. Pigo, good morning to you, sir. Thank you so much. You are a gentleman and a scholar. Thank you for supporting the channel, sir. And good morning. Happy vibes on this wonderful Tuesday morning. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate that very much. Thank you guys for the super chats and my new Melonhead members, as well as all of you magnanimous Melonheads on YouTube and Patreon. Thank you guys so much for everything you do for the channel. Links down below, should you feel so inclined. Don't forget that like button and that subscribe button on the way out for the algorithm. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.